like we're in business. So thank you for joining. We are in a rather interesting time to be selling life insurance. I think undeniably our carrier partners, our distribution friends would certainly agree that this is not as easy to sell large life insurance policies as it has been in 2021 and 2022. We have a few things working against us, and we're going to try to shed some light on each of them in today's webinar. We have a rising interest rate environment. Some aspects of our business, this is a positive thing, but when it comes to long-term, large ticket planning, it becomes problematic. We've had a series of extremely problematic premium finance designs, free insurance, applying a term budget to a permanent need, accruing interest, and we've seen commercial loan rates triple in a very short period of time. Thankfully, at Life Brokerage, we have not, to our knowledge, done any free insurance deals, and have only had one chargeback for a client who probably shouldn't have been involved in finance to begin with, but you utilized the high early cash value rider, so no harm done to that consumer. The balance, though, have stayed on the books. We have an expiring estate tax law, yet it's not coming soon enough. So clients are still on the sideline, potentially waiting for an election to happen in 2024, yet December 31st, 2025, our current exemption will be slashed in half and income tax rates will increase. And we have some opportunity through Secure Act 2.0 that I think helps us sell big ticket life insurance policies. So, we taken 60 days off of work, and we continue to build resources. Showcase a few of them today to help you sell life insurance policies. So I'll jump right to it, and we're going to dive into what are the ramifications of interest rates, rising in interest rate. What we see is this circular motion of, right? So the first thing that will happen is that carriers in a decreasing interest rate environment is that they're going to slow the flow of premium. And what that means is they'll put caps on 1035 exchanges. They'll $1 million maximum, no 1035 exchanges at all. We've seen through COVID. But in the opposite, a rising interest rate environment, we're seeing a lot of those premium restrictions lifted. In fact, better pricing is being released on short pay scenarios. And then if that kind of doesn't do the trick, then companies will reprice. In a rising interest rate environment, they'll reprice products for the better. In a decreasing interest rate environment, they'll reprice pricing for the worse. What we're seeing now is pricing for the better starting to hit the market. We're seeing increased crediting rates and caps. So things are looking up. As far as a pricing standpoint, I feel like the industry has been in quite honestly, a 7 or 8 year recession because of historically low interest rates, which were further exacerbated by COVID. And then lastly, after the price increase or decrease, companies will start to manufacture more product and potentially even leave the market if interest rates are too low. And then conversely, start to see companies adding products to their portfolio, entering the market in a rising interest rate environment. So, I found this interesting. I have to credit my partner Adam DeMarco for creating this and talking us through this. So, the first thing we'd like to do in a rising interest rate environment is overcome the "I don't need insurance, I can do better on my own" discussion. So, if you go out to Bankrate.com and you look at risk-free bank products earning 5.6, 5.5%. That is the average return on death benefit at life expectancy in the products that we sell. So, this discussion has come up more often than not, particularly of late, where clients, have short-term memory. They can obtain 5.5% in a risk-free product today, but they certainly couldn't 2 years ago. So, it's just retraining the mind to remind them that these interest rates are cyclical and they're not here forever. But where I think that we can make an impact is using some creativity with graded premium designs and option C death benefit. What you're looking at here are 4 versions of the same policy. And flexible premium universal life products are just that. You don't have to pay level premiums. So what we're showing here are flexible premium designs, and they vary between policy 1, 2, 3, and 4. Again, same contract, just different funding patterns. And what we've done is we took the present value of all 35 years of cash flow and show that at the bottom at a 3% interest rate. So although some of these back-end premiums get rather daunting if you don't cap the option C death benefit, the single gift or the transfer using the expiring estate tax law is somewhat modest to be able to fund a very significant death benefit with IRRs at life expectancy of double digits or more. So, what you're seeing is option C, which means $10 million face amount plus the sum of all premiums contractually guaranteed. It's very different than option B, which is $10 million face amount plus the cash surrender value or cash account accumulation value. This is $10 million face plus sum of all premiums. The only one that's a little bit different, slightly different, is policy 3, where we cap that return of premium rider at 11.5 million. And you see what that does. You're still hovering and flirting with a double-digit IRR at life expectancy, but you limited your one-time gift in today's present value to 3.2 million to generate 11.5 in return, guaranteed at 9.48%. So this is something that we've been using, opens a ton of doors. And, not every single one of them prospect funds in this graded fashion. But worst case scenario, they elect policy option, funding option number 4, and just pay the level premium, and we sell some life insurance. Also, as a result of a rising interest rate, SPIA rates are extremely attractive to leverage purchases and cover assets for mature clients. So when I say mature clients, because of the fast rising interest rate environment, I start looking at clients age 60 and up, right? Utilize a SPIA to fund life insurance policies. You get a little more leverage than just doing single premiums or short pay designs. And, I can tell you that on a male 70, payout rate's almost up 200 basis points. What we look at here is, and the story we tell here, is guaranteed income streams. So if you continue to harp on the 4% distribution rate rule, and the fact that every financial advisor in the world will tell you, okay, it's time to retire, you have X amount of dollars in your account, you're allowed to spend 4% of that. Well, you can diversify a bit, transfer assets to a SPIA, and generate an 8.4% distribution rate. And from there, you can start effectuating different planning strategies. If you want to back that payment up with life insurance at $32,000 of premium per million, you're certainly welcome to. If you want to divert to hybrid long-term care policies, you sure can, but you're just living better at higher distribution rate products. I have an asterisk here. Keep an eye on income annuities. You don't always necessarily have to give your lump sum to the insurance company in the form of a SPIA. The pricing anomaly today, which we estimate to be 15 to 20% above market, is on income annuities. They are paying far more income than they should be currently. So this $84,000 guaranteed SPIA payment translates to $79,900 on an income annuity. Still gives you access to your 10% free withdrawals, still has a residual value if early death occurs, and you're not quite giving up the entire asset to an insurance company in the form of a SPIA. So please take a look at these in 1035 scenarios, single new money deposits, you name it. It's a great strategy to diversify your income stream in retirement. And again, because of the race to the top and these new money interest rate environment that we're in on the annuity side, start looking at these products at age 60 and up. Okay, how rising interest rates have affected us negatively. The opportunity. Commercial loan rates on premium finance deals have increased. Access to capital for business owners have increased. Our unsecured line of credit at Fulton Bank here at Life Brokerage has increased to 9%. That's a really costly access to capital. I am far better off pulling from my whole life policy in a non-direct recognition fashion at 5% today. So, right, just throwing that out there. AFR rates have increased. So, May of 2020, we were at sub 2%. Today, we're at 4.19 on the long term. So we still have to modify some private loan deals that we have to keep an eye on that we put in place a couple years ago. Policy loan rates have increased. So you're taking internal policy loans from the balance sheet of the insurance company with collateralizing the product you own. Those rates have gone up, particularly if they're tied to Moody's corporate bonds or any other type of index. Offsets are not working like they should be working. Be your own banker may not be arbitraging, right? You want to really dig in. Whole life line of credit programs not working like they should. So it is an opportune time to identify the potential prospect and then start to look to modify the plan. Your clients have 3 options, and that's it. They could do nothing, right? Continue as is. Number 2, they make changes to the existing policy. You can pay down the loan using dividends. You can take out a policy loan to pay down the commercial bank. You can do things internally to make changes to the existing program. You can transfer the loan and the policy cash value via 1035 exchange. So what you're identifying here is so important. Get an in-force, learn what the basis is. What we found in looking at dozens upon dozens upon dozens of these designs is look for the taxable gain. If you have a taxable gain in the policy, it will lead you to the most appropriate decision on this screen, 1, 2, or 3. If you have a taxable gain, you're likely going to want to transfer the loan and the policy cash value to a new contract at more favorable terms. If you do not have a taxable gain, then you make a decision, number 1 or number 2. And we've built some spreadsheets to help you. And I'm going to go through a case study right now that's going to identify some of the direction that we're going in. And this is the most common that we see. In this instance, we did not have a taxable gain. We were underwater. So we owed more to the commercial bank than we had in policy cash value. And this is what you're going to see 8 out of 10 times. The 2 out of 10 times that there is a gain, we have a real easy solution. The 8 out of 10 times where the consumer does not have a gain, it's not an easy solution, but it is a better solution. So I'm going to walk you through this in a few different spreadsheets to show you how we arrived at this decision. So this is a 53-year-old male, not a 63-year-old male. 35 million gross face amount for buy-sell planning. He and his partner financed the premium. They were making tons of money in their business, and they felt like they could deploy their capital back into their business and continue to grow it, which they successfully did, and eventually sold the majority interest in their business in 2021 for a lot of money. So the strategy was not a total failure. They did really well in their business, and they did arbitrage the borrowing rate from Wintrust versus the growth rate in their businesses. So the issue here, $3.1 million of cash value, yet they owed Wintrust $5.6 million, and the loan renewal just came due last week, September of 2023, 7.79 interest rate. So this gentleman has a partner, total loan out $13 million. So on a $13 million loan, 7.79% interest rate. This is not a knock on Wintrust. This is the going rate in today's market. So after I pay off Wintrust, consumer has 29 million in today's dollars. We looked at internally, there's an IUL policy that was securing this loan and funding the death benefit. That policy had an internal fixed loan of 2.5%. This is pretty attractive. This was certainly considered in the analysis. So, definitely want to identify what's the internal loan rate at the existing carrier. So the life insurance policy served its purpose, but now the client's life insurance goals have changed. He no longer owns the majority of the business, had a huge liquidity event, needed to shift the death benefit purpose for estate planning versus business planning, and definitely wanted to get out from under the 7.79% annual interest payment. So the analysis that we start to uncover: stay the course and reshuffle the ownership, right? Which means continue to finance, create proper ownership to trust versus cross purchase, and just reshuffle the deck. Number two is, does it make more sense to take a policy loan at 2.5% and pay down the Wintrust loan at 7.79%? Arguably less, but we need to see the long-term effect of that. And part two of that, I would say 2A was look internally. 2B is, do I take an internal policy loan and then 1035 the existing policy to the new policy with better loan terms where they mirror the loan on the books? And there are a few carriers in our stable that will do that and accept 1035s with policy loans. Or the tough pill to swallow is to surrender, forfeit your collateral, and start over. So, I'm going to walk you through this because it's very relevant in today's environment. So, I broke up these spreadsheets into the least amount of columns so you can see them on our screen, but it's a really large spreadsheet that runs, 20 plus, almost 30 columns, so you can see the different iterations. But so first is stay the course. Column 4 shows you continuous borrowing, crediting rate or AG 49B crediting rate, default crediting rate decreased significantly. So the best we can show is 4.82. What happened there is that this is policy several years old, supposed to be funded in 2 more payments. Well, we needed to actually extend that to 8 more payments. I pushed guideline in policy year 4, which is like policy year 11 in the policy, so I couldn't continue to borrow 1.1 million or I would violate guideline and MEC. So max funded the policy the minimum number of years to carry 35 million out to maturity, 35 million of death benefit. And I'm showing in column 6 a pretty dramatic model, but I think it makes sense and hits home, and clients need to understand the concept. 7.79% bank rate loan today and for the next several years, and then normalize in year 6. So we're looking at servicing interest out of pocket in column 7, cumulative interest payments in column 8, collateral, which is a big deal to this particular gentleman, in column 9, and then what is the net effect in column 12? So if you run down a life expectancy, your cumulative out of pocket in column 8 is $21 million to net $23 million of death benefit. Probably not the best use of funds. So then we said, okay, instead of funding the maximum, why don't we take a defensive position and fund the minimum premium? So go back, run an in-force ledger. Instead of 1.1 million of premium on a short pay, we're going to do 311,000 on a full pay, right? We're going to borrow the least amount of capital as possible in this high interest rate environment and take a defensive position. And then in this instance, didn't really help. 22 million of out of pocket in column 18 versus 17 million of net death benefit in column 22. Probably not the best solution so far. It's let's continue to stay the course in option 1. Now we're going to look at, okay, we're going to go back to the in-force carrier. We're going to say, what's the max loan I can take on a $3.2 million cash value, $3.1 million cash value today, so that I can take from the existing company, go buy down the commercial bank loan at 7.79%. And then the existing carrier comes back to us and says, you can take a $3 million loan today. We'll charge you 2.5% interest, which means you owe us $75,000 in arrears of each year, every year the loan is out. So we explained to the client, okay, you can tap the existing company for $3 million, pay down Wintrust by $3 million, okay? And you have more favorable terms at 2.5% outlay versus 7.79. Does this work? Well, yeah, it saved the client a bunch of money. We remember we were at 21 million cumulative out of pocket in column 12 in the first scenario, but I end up with a net death benefit of 13 million because I didn't drive a whole lot of premium into the contract using option B to make that projected death benefit grow. So we controlled out of pocket, but 11.5 trading for 13.5 at death, maybe not the best. Now, in more instances than not, column 6 is a far greater number than 2.5%. Right? This was a very loan friendly carrier. So, you have to be mindful of what is the existing insurance company charging to borrow internally and plug that into this spreadsheet. So, also we felt like in order to do our due diligence, we had to show, okay, what if we effectuated this $3 million loan from the existing carrier, serviced interest, and then when bank interest rates normalized, we put it back. And that's what we did in this model. So why not show this using a new carrier and a mirror loan where we effectuate a 1035 exchange with the $3 million policy loan over to a new carrier with a 2% policy loan interest rate? Didn't make a whole bunch of impact, but it looks slightly better. Cumulative out of pocket is a little bit less, net death benefit a little bit more. Again, not the ideal solution. And here we go. We're going to land the plane. What we're seeing comes back to the very first asterisk and highlight that I shared with you on this section. Look for the taxable gain. If there is no taxable gain, we are finding that 9.9 out of 10 times, it is more effective to bind new coverage, non-financed new coverage, surrender out your existing, right? So you don't have a break in coverage, and pay off the existing bank loan. So I know this is a tough pill to swallow, but surrendering the collateral or your least favorite asset to pay off any shortfall between Wintrust and the policy cash value, in this instance was 2.4 million, was far more cost effective in the long run and nets significantly more death benefit in the long run than the other scenarios we looked at. If you make your collateral, delta payment in year one to buy out Wintrust of 2.4 million, and then subsequently buy a survivorship guaranteed universal life policy at $183,000 a year in column 16 for 23 million of net death benefit, because that's what I was focused on in the finance scenario. I know they had 35 million of death benefit initially, but after all loan debt and repayment to Wintrust, the family was only going to get 23 anyhow. I only need to effectuate a new purchase of 23 million if I'm really looking to compare apples to apples. So what we're showing is several $1 million of lower client outlay. We have guaranteed the death benefit and premium, eliminated all bank rate risk, and cleaned up any debt on the front end in the existing transaction. So again, it comes down to, and we have been thinking obsessively over how to rescue some of these uncomfortable premium finance designs. If there is no gain in the existing contract, or you're not looking to, there's some preservation of basis interest, it is better to surrender out and start over in a non-finance design. And no one says again here that you have to pay $183,000 of level premium. You can also utilize a graded structure if it helps drive IRR. This particular client just wanted peace of mind, guarantees, and not have to think about this any longer. Okay, this is a big one, right? And I get this question a lot. If you were going to finance a policy today, forget the existing policies and the loan rescue strategies. If you were going to finance a policy today, what would you do and how would you do it? Well, I don't know if I would finance a policy today. I like flexibility. I like a wait and see approach. And there is a particular carrier and policy that I feel gives you the best of both worlds. And that is a New York Life survivorship whole life using a convertible dividend option term rider. And I'm going to walk you through this. And there's a lot of numbers on this page, but I wanted to show you the spreadsheet in its entirety. This is a male 53, female 53, who has a need for $25 million of survivorship whole life. Now, if they went straight to an all-base design for $25 million today and had to borrow money at 7%, the 10-pay premium on this case is a little over $1 million. So that means in column 6, year one interest is $74,000. If interest rates stay at 7% and go up to 148, 223, and 297, pretty expensive to finance, and it's a pretty big hurdle rate to overcome the 7%. Not impossible. We still have clients doing it who understand the risks, but these clients also have the ability to pay the $1,063,000 if they needed to. Now, I'm going to show you a little bit of a different approach and a feature to this particular program. We can add a convertible term rider, and the conversion is good for the greater of 10 years or age 60. I can design a plan with 20% base whole life and 80% term rider. That's the maximum. You can go anywhere in between 100% base and 20% base. The cost in this example, right? 5 million base, 20 million term rider. The cost for the 20 million term rider is $3,800. That is your put option. If you focus on the cash value in column 11, so the premium in the first, call it 5 years on the base policy is $216,000, not $1,063,000. Okay, so if I intend to borrow the first year premium, I'm borrowing significantly less at increased interest rates. Let's say year 6 comes and I want to create a conversion. Well, I can convert 20 million of that term rider for 980,000 beginning year 6, which you're seeing in column 13. And I'll do that once interest rates normalize. Okay. If I don't want to do that and interest rates didn't normalize, well, my cash value in column 11 just about equals the cumulative premiums paid. And that's my ripcord. That's my full liquidity, right? That's my exit. So it gives me this wait and see opportunity to watch interest rates normalize, continue to think about my planning, but it gets my program started, builds in a buffer, starts to accumulate cash value. And I'll show you where that becomes attractive in the next slide, because financing the 5 mil base and future converted term rider is far more cost effective in my cumulative out of pocket column 20. And I'm showing you that if I can bank the difference between financing the full base premium versus the 20/80 blend in column 23 at 6%, I'm creating a huge bucket of side fund. I have full liquidity. I have optionality to convert when I want, the greater of 10 years or age 60. Now, if we can demonstrate the concept using this piece, now we may be able to convince the consumer, don't borrow the base premium in the first 5 years at 7%. Pay those premiums out of pocket. Give this program a fighting chance and get off the ground running, because in the end of the 5th year, when you do want to convert and potentially finance, you will have a buffer of over $1 million of cash value. So you have mitigated almost all of your collateral requirement from that year on. And if you can take it a step further and convince them to pay the base premium for 10 years, then you eliminate all collateral, and given today's dividend rate and the interest rate of some type of normalization of, call it 5%, you can then accrue interest for the remainder of the program, years 11 on. And if you want to, don't need to, if you want to, you can roll out from this deal far sooner than a normal finance strategy, as early as year 11, as late as year 17. So that question comes up a lot. If you were going to finance a policy today, what would it be and how would you do it? This would be exactly how we would do it and have been doing it. Okay, so I'm going to move on. Again, life insurance is the new stretch. All right, I'm going to give you the abbreviated version here, and this is a resource that we've built. So rising interest rates, strong market returns have increased the value of IRA assets. I'm going to get right to it. IRA assets at $500,000 or less, forget it. They'll be consumed over the participant's lifetime. Not really a big deal to die with those assets. You probably won't. You'll more than likely spend it. IRA assets or qualified assets between $500,000 and $1 million, somewhat affected by the Secure Act. I'll explain why, but a good portion of them will be consumed, and the remainder are going to present such a small tax liability that you probably don't want to go through a whole bunch of work to solve for the mitigation. Now, qualified assets $1 million or more, they're largely affected because the participant will not likely spend those over their lifetime. And there will be a decent amount of tax liability that follows, particularly in an inherited IRA strategy. What we're really focusing on is the $1 million qualified plan and consumer who's subject to federal estate tax. Maybe not today, but in 2026. So keep in mind that the $13 million exemption is going to be cut in half, and that kind of pops back up on the radar in 2026. These folks are always affected by Secure Act. So let me explain what has happened. The Secure Act 2.0 confirmed Secure Act 1.0 that requires the entire balance of an inherited IRA to be distributed or withdrawn within 10 years of the death of the original owner. So you have to empty the account 10 years from the death of the original owner. Years ago, we would just leave the IRA to the spouse. The spouse would then transfer an inherited IRA to the children or grandchildren. The children or grandchildren would draw down at their RMD, given their age bracket, in coordination with the RMD rules. Now, that still happens, but you can only do that for 10 years, and then the account has to be liquidated. So Putnam put out a really cool chart based on the age of the beneficiary and the payout period in years and the number of years lost due to the Secure Act. So what you're seeing here is like a 2-year-old, right, who inherits an IRA is losing 65 years of potential deferral because of this 10-year rule. Well, it's pretty dramatic, but that was effective planning, right? If you name your 2-year-old grandchild the beneficiary of your inherited IRA, you could stretch that thing over 75 years. Well, in this instance, today, you're only allowed to stretch over 10, And then every single penny comes out taxable ordinary income to the participant. So what we've been doing is building resources around this. And I'll take you through, I love these case studies. Male 62, female 65, preferred, net worth 40 million. So they had just kept it easy, 35 million non-qual and 5 million qual. So very simple. Retired CFO of an ESOP company. They already own $15 million of a Prudential survivorship guaranteed VUL policy. You look at it, you're like, wow, they did a good job. That's a great policy. They own a bunch of insurance, but no, don't stop there. Keep digging. Let it run through the model, fact find, understand what the client has, and let us show you what we've built. So the software that we built is a macros-based Excel file. We show current planning on the left, just isolating the $5 million IRA, and what we will recommend on the right, which is to spend down that entire IRA because your beneficiary is going to have to do it anyway, in conjunction with the current tax law before it sunsets, right? If nothing happens, ordinary income tax rates are going up by 2.9% on the Fed side. The states are looking for money. There's mega IRA bills being proposed. Country has $33 trillion of debt. Watch out for increased tax rates. What this does is gives us a calculation on how to spend down in the most efficient way. 1 year, 3 years, 5 years, 10 years, 20 years, 30 years, and then buying life insurance with the spend down. So you're spending down your IRA, you're paying your income taxes today in today's tax rate, making gifts to a trust to then effectuate a life insurance policy. And you see the difference between columns 16 and 17. It is a huge margin of victory all the way through the consumer's age 98 years old. So there are planning tools to use to continue to sell big ticket life insurance cases in Q3, Q4 of 2023. The market is not dead. Pricing is coming back around in our favor. And I would tell you, just get your hands on the data, share it with the folks here at Life Brokerage, and we will run these analysis for you and help you teach the consumer what their potential planning options are, and will potentially lead to a good amount of life insurance. So we are 2 minutes ahead of schedule. I want to thank you for attending our September webinar. More to come. Everyone stay safe. Again, we appreciate your time. A recording of this will be circulated along with a copy of the slides and some of the templates that we discussed. So at this moment, we'll bring the meeting to a close. And again, I thank you for your time and have a wonderful day and remainder of the weekend.